They smashed it. And the reason matters more than the size of the drop, because this wasn't TA Silver changed its mind today. This was leverage getting shut off at the switch, right when the market was stretched, right when liquidity was thin, and right when the calendar was set up to punish anyone who confused a bull market with a straight line. Silver had just printed record territory around the mid-80s, and then, in what looked like a single breath, it fell roughly $9 into the low 70s. That kind of candle makes people reach for explanations that feel human. A headline, a rumor, a surprise data point. But the force that does this to a market isn't a story. It's math. And the conflict is simple. The crowd wants to believe this is just profit-taking, while the plumbing is telling you something sharper. When the exchange raises the cash you must post to hold the same contract, it turns the market into a liquidity test. And liquidity tests don't care about your conviction. And here it's the hidden detail most people miss in real time. A paper price can collapse while the physical signal stays stubborn, even loud. Because paper is where leverage lives, and leverage is what gets liquidated first. Stay with me, because the payoff isn't just why it dropped. The payoff is what happens next week when the market has to decide whether this was a cleansing flush that reloads the trend, or the first crack in a structure that has been stretched to the edge. And there are specific zones and specific behaviors to watch that will tell you which path you will re-in before the crowd catches up. Now zoom into the sequence, because the timeline is the fingerprint. The market runs hard, fast, vertical. Silver doesn't usually do polite rallies. It does sprints. When it finally tags the highs, the tape looks invincible. That's when the conditions for the smash are already in place. You have end-of-year positioning. You have holiday liquidity. You have a commodity that S, both industrial and monetary. So it attracts two different kinds of momentum at the same time. And you have a derivatives complex where a lot of participation is expressed through futures and options. Which means the market is not just people buying and selling, it's dealers hedging and funds managing risk limits and clearing members watching collateral. And that's where the real pressure starts. Because when volatility rises, the exchange doesn't sit there and watch. It raises performance bond requirements, what most people casually call margins. That single action changes behavior instantly. If you were holding a standard COMEX 5 1,000-ounce silver futures contract, the required cash to maintain that position was lifted from roughly $22,000 to about $25,000 with even higher requirements for accounts flagged as higher risk. On paper, it sounds like a routine adjustment, a few $1,000s. In practice, it's a forced decision. Add cash, cut size, or get closed out. And you don't get to negotiate with the margin clerk. But that's not the part that matters. The part that matters is what happens when that decision lands on a market that is already top-heavy with leveraged longs and short-dated speculative money. The first wave is not bearish conviction. It's triage. It's people selling what they can, not what they want. It is the clearing system demanding more collateral at the exact moment price is moving against anyone who chased the top. And as soon as those initial sells hit, the second wave triggers. Stop orders. Not thoughtful stops. Not risk management stops. Clustered stops under obvious intraday levels, under prior day lows, under round numbers that everyone can see. And when those trip, they become market orders in a thin book. Then the book gaps. And once you gap, you invite the third wave, systematic de-risking. Volatility goes up, VAR limits get hit, risk parity reduces exposure, funds that size by volatility mechanically cut. That's when a normal pullback turns into a trapdoor. Because if this one level breaks, the math changes. That's what a smash is. Not a mysterious hand pressing the price down, but a chain of forced behavior that accelerates once the first domino falls. Now, if you're listening to mainstream commentary, you'll hear it framed as profit-taking after an explosive year. And yes, profit-taking is real. After a year where silver was up well over 100% and gold also had a historic run, funds do lock in gains, especially into year-end. But profit-taking alone doesn't carve a clean air pocket move. Profit-taking dribbles, forced liquidation drops, and that's the critical distinction because it tells you what kind of selling it was. Was it an investor changing their mind about silver's future? Or was it a leveraged participant failing a cash test? Those are different sellers. Investors sell in an orderly way and often buy back. Liquidations sell fast, ugly, and often mark the low because they exhaust themselves. And that's where the opportunity, or the danger, hides. Watch the behavior, not the feelings. Here's the mechanism in plain language. A futures contract is a leveraged instrument. You don't pay the full value. You post collateral, a performance bond, to guarantee you can cover the daily profit and loss. When the exchange raises that requirement, it's effectively saying, this market is volatile enough that we demand more cash behind every position. If you have the cash and the stomach, you wire it and keep going. If you don't, you reduce the position. And if you're overextended and the market is already moving against you, you get forced out at the worst possible time. That's why margin hikes often coincide with sharp sell-offs in hot markets. Not because someone decided silver should fall, but because the plumbing tightened. And when plumbing tightens during thin liquidity, price discovery becomes violent. The next detail is what flips the whole setup. A margin hike is not evenly distributed pain. It hits the most leveraged, most recent buyers first, the ones who chased the last leg. Those are exactly the holders who will puke on the first downtick. So the sell-off tends to overshoot because it's not a rational vote, it's an unwind. And overshoots are where markets either break or reset. But you can't call that an advance by vibes. You call it by signals. Now add the calendar trigger, because this is the why now that makes the move make sense. We're at year end. Liquidity is thinner than normal because a lot of desks are partially staffed, a lot of real money has already adjusted positions, and a lot of risk is being run tightly into reporting dates. That alone increases gap risk. Then you layer in a specific effective date for higher margins after the close of business. That concentrates stress. People don't gradually adjust over a month. They scramble into a deadline. And then, hanging over all of it, you have a geopolitical industrial calendar catalyst, an export licensing regime and resource politics narrative that's about to flip the next day. Whether you fully buy that story or not, markets trade the anticipation of constraints. They front run, they distort, and then they whip. Especially when a metal sits right on the seam between monetary hedge and critical industrial input. And silver is exactly that seam. So you have a thin liquidity week into a margin hike effective date into an information catalyst with a chart that had gone vertical. That is a recipe for a flush. And that's where the real pressure starts. Now let's talk about the hidden detail that reframes the whole story, because this is where most investors either get saved or get baited. When paper silver collapses, you need to ask one question. Did the physical market loosen, or did the paper market delever? Those are not the same event. Paper can move $10 because futures participants got forced out. Physical doesn't reprice that cleanly because physical is bottlenecked by refining, fabrication, logistics, and regional demand. In the days leading into this kind of volatility, you often see a tell. Premiums in key delivery markets widening relative to the futures benchmark. Not because everyone suddenly got emotional, but because immediate deliverable ounces are harder to source at the posted paper price. In Asia, particularly in China, price formation can show this in a very blunt way. Spot or near spot contracts trading at a noticeable premium to the Western benchmark. That's backwardation behavior. The front is tight, and when the front is tight, the market is telling you, if you want it now, pay up. That signal can persist, even if futures get hit, because futures are where leverage and liquidation live. So when you see a smash, don't just stare at the red candle and assume demand vanished. Ask, what did spreads do? What did premiums do? What did availability look like? Because if physical tightness remains, then the smash is more likely to be a leverage flush than a fundamental break. But that's not the part that matters. The part that matters is what that physical paper tension forces participants to do. If physical is tight and paper gets smashed, arbitrage becomes the bridge. In theory, if Shanghai is paying more than New York, metal flows should move to close that gap. In reality, metal doesn't teleport. It has lead times, it has form factors, it has rules, and it has financing costs. So the arbitrage is not instant. That delay is where price can snap back, because the cheap paper invites buying while the tight physical prevents the story from fully breaking. And that's why silver is one of the most reflexive metals on Earth. It can fall fast and rise faster, because it sits inside a derivatives machine that amplifies both directions. Now let's address the obvious skepticism before it bites you. If the market is so tight, why can it fall $9 in a day? Because tightness in a commodity does not immunize it from liquidation. Tightness is a slow variable. Leverage is a fast variable. Slow variables set the long-term bias. Fast variables create the scars. A market can be structurally undersupplied and still crash if too many participants are using borrowed exposure. That's not a contradiction. It's the signature. Think of it like a crowded theater. The room can be full because demand is real, but if someone yells fire, the exit dynamics, not the attendance, determine the stampede. Leverage is the stampede factor. And when margins get raised, that's the usher, narrowing the exit while people are already moving. But here's the trap. The same dynamic that creates the smash is the dynamic that can create the rebound. When liquidations finish, selling pressure evaporates. Then the market doesn't need new buyers to bounce. It just needs the absence of forced sellers. That's when you see those violent V recoveries that make everyone feel stupid in both directions. And that's where the real pressure starts again. Because once the bounce begins, the market hunts the other side of pain. Shorts who pressed into the flush and now have to cover into a rising tape. Now bring in options and gamma. because this is the layer that makes the move feel unnatural if you don't know the plumbing. In fast-moving markets, dealers' hedging flows can dominate intraday. If a lot of call options were bought during the run-up, dealers who sold those calls hedge by buying the underlying as it rises. That can support and even accelerate the upside. But when price turns and volatility shifts, the hedging flips. Dealers sell as price falls to stay hedged. That turns a move into a cascade. And it's not a conspiracy, it's a mechanical feedback loop. This is why you can get a day where silver feels like it's being pushed in one direction, then slammed in the other. It's hedging plus liquidity plus positioning. And the next detail is what flips the whole setup. As volatility rises, option implied vols rise, which changes Greeks, which change hedging intensity, which changes flow. The market becomes reflexive. Price changes flows. Flows change price. In that environment, headlines are mostly passengers. Now, the evidence stack matters because you can't build trust on one argument. So let's stack it cleanly. Proof point 1, the magnitude and speed of the drop fits a forced deleveraging profile, not a slow revaluation. $9 in silver is a structural event in the paper market. Proof point 2, the margin change is a direct, documented tightening of leverage right into the move. When collateral requirements rise, forced selling becomes likely among leveraged participants. Proof point 3, the calendar, year-end plus thin holiday trading, is exactly when order books get fragile and gap moves become easier. Proof point 4, silver's dual-use nature means it attracts both macro hedgers and industrial narrative money, which tends to create crowded positioning when the trend is strong. Crowded positioning is what turns margin changes into cascades. Proof point 5, the global context, strong buying interest and discussion around supply constraints and strategic stockpiling is inconsistent with demand died overnight. What changed overnight was the ability to carry leveraged paper exposure. Proof point 6, and this is the one many people ignore. The way the market behaves after the smash tells you what kind of selling it was. If it was liquidation, you often see fast rebounds, intraday reversals, violent two-way trade, because once the forced sellers are gone, the market whips. If it was a true fundamental break, you tend to see grinding follow-through and weak rebounds that get sold. So the story isn't finished on the down day. The story is written by the next few sessions. And that's where the real pressure starts. Now let's talk about the paper versus physical tension without turning it into cartoon conspiracy. Incentives matter. Futures markets are incredible tools for hedging and price discovery, but they also allow massive notional exposure relative to immediate physical availability because they net and roll. That's fine most of the time. But when physical becomes tight and demand is urgent in certain regions, the futures benchmark can lag because the benchmark reflects financial flow as much as it reflects, I need metal now. When that happens, you can see weird things. Spot premiums, dislocations, backwardation episodes, retail product shortages or higher dealer premiums, and a lot of noise on social media that's half wrong but emotionally true. It doesn't feel like the market is loose. And here's how you keep it finance credible. You don't claim the price is fake. You say the benchmark is a financial instrument subject to leverage, margin, and hedging flows, while the physical market is subject to fabrication capacity, logistics, and regional demand. Those two can diverge temporarily. When they diverge, volatility rises. And volatility is what the exchange is responding to when it raises margins. So the exchange isn't causing the move out of nowhere. It's reacting to a market that's already unstable. But reacting by tightening collateral during thin liquidity can amplify the instability. That's a sober, incentive-based explanation, and it matches the fingerprint we just watched. Now, let's anchor what this means to you this week, because this is where most viewers either regain control or get emotionally manipulated. The market will try to put you into a binary mindset. Either silver is over, you were wrong, or this is the dip of a lifetime, back up the truck. Both are emotional traps. The truth is almost always a scenario tree, and the only way to trade or invest scenario trees is to separate trend signal from noise. The trend signal is the multi-month structure. Macro regime, real yields, currency stress, industrial demand, supply constraints, institutional flows. The noise is the violent daily candle produced by leverage, a margin stops in hedging. Noise can still hurt you if you size wrong, but it doesn't automatically invalidate the thesis. The key is to define what would actually invalidate the thesis, and what would merely be pain along the way. And that's where the real pressure starts, because defining invalidation levels forces you to stop listening to the crowd. So let AS map the board in a way that ES usable, without pretending we have perfect precision. Silver just came off record highs in the mid-80s area. It then slammed into the low 70s. That creates a very clear set of zones. On the upside, the first obvious resistance band is the mid to high 70s, where the rebound often stalls after a flush. Above that, The psychological 80 area matters because it S where the crowd re-engages and where short sellers start to feel heat. Above $80, the record zone near 84 is the line the market can see. If price reclaims that area and holds, the smash starts to look like a liquidation wick rather than a reversal. On the downside, the low 70s zone is immediate battlefield territory because it S the zone the smash landed on. If that zone holds and the market starts building higher lows, it's a classic flush and base behavior. If it fails cleanly and you start seeing closes well below it, you open the door to a deeper unwind. Not because silver's long-term story dies, but because the market may need to find a level where leverage can rebuild. A round number like $70 becomes a magnet in that case, not because it S magical, but because it S where stops cluster and where positioning shifts from panic to value. But that's not the part that matters. The part that matters is the confirmation behavior around those levels. Does the market bounce on heavy volume and then digest, or does it bounce and immediately get slammed? Do spreads and near-term tightness stay firm, or do they relax? Do you see signs of stress and volatility staying elevated, or does volatility compress as the market calms? Because if volatility stays high, it's telling you the leverage machine is still unstable and you should expect more whipsaws, even if the thesis is right. And you need to internalize this. Price can whip around violently, even when you are correct on the direction. Being right and being early are not the same thing, and leverage punishes both. Now, add institutional behavior, because retail investors tend to imagine the market is mostly other retail investors. In silver, it isn't. You have producers and industrial consumers hedging. You have funds rotating between metals. You have systematic strategies that treat metals like a basket and rebalance. And into year end, you have an additional force, reporting optics and risk budgets. A fund that S up huge doesn't want to risk a giant drawdown into the close. They reduce. A fund that has a mandate to maintain certain exposures may rebalance. A fund that has exceeded volatility targets will cut. That means flows into year end are not purely views. They are constraints. That is why the end of a year can produce both sudden dumps and sudden spikes, because constraints change abruptly with time. And the next detail is what flips the whole setup. A new year resets some of those constraints. Risk budgets refresh, allocations reset, strategies rebalance at the turn. That means the behavior in the first week of January can be dramatically different from the last week of December, even if the fundamentals are identical. That's why this is a calendar trade as much as it's a metal trade. The why now isn't just silver is volatile. The why now is constraints shifted into a thin market right before a calendar flip. And that is the kind of environment where the tape lies to people who think one day is destiny. Now let's talk supply chain without doing a history lesson, because you don't need a textbook to understand the bottleneck logic. Silver supply is not like oil where you can turn a spigot. A large portion of silver production is byproduct. It comes out of mining for other metals. That means a higher silver price doesn't automatically create a fast supply response. Refining and fabrication have lead times. Industrial demand, particularly from electronics, solar, and high-density applications, doesn't vanish because the chart got ugly. Procurement people don't cancel orders because a candle was red. They cancel because the underlying demand collapses or because substitutes become cheaper and feasible at scale. Substitution exists, copper, aluminum, different chemistries, but it is slow and capital intensive. So if you're in a macro regime where industrial demand remains strong and inventories are not comfortable, then a paper smash is more likely to be a volatility event than a fundamental reset. That doesn't guarantee price goes up tomorrow. It tells you the medium-term bias can survive a violent shakeout. And that's where the real pressure starts, because medium-term bias is useless if you size like a day trader and panic like a tourist. So here's your viewer psychology shield, and I want you to actually use it, not just nod at it. First, recognize the manipulation that volatility performs on your brain. Volatility makes you mistake intensity for information. A $9 down day feels like new knowledge, but often it's just old leverage getting forced out. Volatility also creates recency bias. You overweight what just happened and underweight the structure that created the trend. And volatility triggers the worst possible timing instincts. You want to sell when it feels dangerous and buy when it feels safe. Markets are engineered to punish that reflex because the crowd shares it. The defense is simple. You define your time horizon before the candle prints. Are you positioning for a macro regime over months, or are you trading a swing over days? If it's months, you accept that days like this are part of the cost, and you focus on structure and invalidation. If it's days, you accept that you can be right and still get stopped, and you manage risk accordingly. Second, stop anchoring to the top. The market will try to hypnotize you with, it was $84. That's a psychological anchor that makes $72 feel cheap, even if $72 might not be the low. Price is not cheap because it is lower than yesterday. Price is cheap if the future cash flows or future scarcity justify it relative to alternatives and risk. Third, implement a two-scenario lens so you don't get tricked into binary thinking. Scenario 1 is the controlled pullback and retest. Silver stabilizes around the low 70s to mid 70s zone. Volatility begins to compress. You see higher lows, and any pushdown gets bought without panic. In that scenario, the smash was a cleanse, and the trend can reassert after digestion. Scenario 2 is the continuation squeeze. And yes, it can be a squeeze in either direction. If the market rebounds sharply, shorts and late sellers can get trapped and forced to buy back, creating upside gaps into $80 and beyond. But if the market fails to hold key support and volatility remains elevated, you can get a secondary liquidation leg, where the dip buyers become the next forced sellers. The key is, both scenarios are plausible right now because the market has just been shocked. Your job isn't to guess with certainty. Your job is to watch for confirmation. And that's where the real pressure starts, because confirmation is boring, and boredom is where disciplined money makes decisions while the crowd waits for drama. So what are the confirmations? If you want the controlled pullback and retest scenario, you want to see stabilization in the low 70s zone and rebounds that don't immediately get sold into oblivion. You want to see the market regain the mid 70s and hold it long enough for dips to look like opportunities rather than emergencies. You want to see volatility stop expanding, not necessarily collapse overnight, but stop making new highs. And if you track market structure signals, you want to see front-end tightness not completely disappear. You want the curve to behave like a market that is still bid for physical delivery, not one that suddenly has too much metal. If you want the continuation squeeze scenario to the upside, you want to see aggressive reclaim of the $80 zone with speed, because speed is what traps participants. Slow grinds invite selling. Fast reclaims force hedging and covering. You also want to see pullbacks after reclaiming $80 hold above prior breakout areas, because that's the market proving it can absorb profit-taking without collapsing. On the other side, what would weaken or invalidate the bullish red? A clean failure to hold the low 70 zone combined with sustained high volatility would be a warning that leverage is still unwinding and the market needs lower to reset. A failure rally, and where price spikes then immediately collapses back into the range, would suggest distribution rather than a healthy base. A clear relaxation in physical premiums and a curve that shifts into comfortable contango would suggest near-term tightness is easing, which would remove one of the supports under the narrative. None of this guarantees direction. It gives you a roadmap, and roadmaps are how you avoid panic decisions. Now, there's one more layer people miss because they're too focused on the candle. What this move forces other participants to do next. Clearing members and brokers will tighten risk controls after a volatility event that change the behavior of leveraged retail and smaller funds. They will trade smaller, they will require more cash. That tends to reduce froth temporarily, which can calm the market after the shock. But it can also reduce liquidity further, which means the next move up or down can still gap. Meanwhile, industrial users who have been watching prices rip higher may view the smash as a procurement window, not because they love volatility, but because they need supply and they don't want to chase the highs. That demand can appear quietly, not on your chart as a headline, but in the way dips get bought. Funds that missed the move may also use the smash to initiate exposure with better risk harsh reward, but they won't show up as a single print. They show up as persistence, repeated buying on weakness. That's why the next week matters. The market has to digest new collateral rules, new calendar conditions, and new positioning, and that's where the real pressure starts. Let's also address the institutional suppression vibe that always shows up in silver, because it's emotional and sometimes it's rooted in real incentive structures, but it gets people hurt when they turn it into certainty. You don't need a villain to explain a leverage flush. You need incentives. Exchanges want to reduce default risk. They raise margins when volatility rises. Traders want leverage when trends are strong. They get forced out when margins rise and price turns. Dealers hedge options mechanically. Funds manage VAR mechanically. Those are incentives. Those incentives can create outcomes that feel like suppression, especially in a market with a history of sharp reversals. But the safe way to talk about it is not they control the price. It's the structure can amplify reversals and policy changes, like margin hikes can act as catalysts. That keeps you finance credible and keeps you out of the trap of blaming ghosts instead of managing risk. Because the market doesn't pay you for being right about villains. It pays you for being right about flows. Now, let's pull the camera back for a final synthesis that you can actually act on. Silver just demonstrated that it is not a sleepy commodity. It is a high beta, reflexive instrument sitting at the intersection of macro, industry, and derivatives. The smash was a liquidity event triggered and amplified by tighter collateral requirements into thin year-end conditions after an overextended run. The hidden detail is that this kind of move can occur without the underlying industrial and physical story breaking, because paper is where leverage unwinds first. The why now is calendar plus policy effective dates plus positioning into a turn of year. The mechanics are margin pressure, stop cascades, and hedging flows. The proof stack is the documented margin change, the timing, the magnitude, the year-end liquidity, the extraordinary year-to-date run that invites profit-taking, and the ongoing backdrop of supply tightness and industrial demand that doesn't flip overnight. And now the what comes next is not a prophecy. It's a checklist. Watch the low 70s zone for stabilization. Watch the mid to high 70s for acceptance or rejection. Watch $80 as the psychological line that changes behavior. Watch the record zone near $84 as the market can't unsee it line. Reclaiming and holding it would strongly support the idea that the smash was a liquidation wick. Watch volatility behavior. Expanding volatility means more landmines. Compressing volatility means the market is regaining stability. And keep the two scenarios in mind every single day, because it protects you from getting emotionally hijacked. Scenario 1, controlled pullback, base builds, trend resumes after digestion. Scenario 2, either a fast upside squeeze on reclaiming key levels or a secondary liquidation if support fails and volatility stays elevated. In both scenarios, you respect the truth that price can whip around violently even if your thesis is right. That's not a disclaimer. That's the game. And here's the quiet warning that separates professionals from tourists. The market will try to use the next spike, up or down, to make you abandon your plan. If it rips, it will make you chase. If it dumps, it will make you capitulate. Your edge is not predicting the next candle. Your edge is refusing to let the next candle rewrite your rules. And if you want to build a community of people who trade and invest like that, who read the plumbing, who track the real confirmations, who don't outsource their decisions to panic, then stay close, because this is exactly the kind of tape that creates generational mistakes for the crowd and generational opportunities for the disciplined.